G'day there, welcome to the closing bell video on the 22nd of January. Now, if you've been watching these videos and caught up with my closing bell video last week, you shouldn't be too surprised by what went on over the week with the selling pressure really increasing in stocks, a few key levels broken there. So we'll be having a good look at the equity market in the US and our market as well, following up after a pretty volatile week. I don't know what happened last night in the States, you do. But I can imagine it would have been fairly volatile. Just want to give you an update on the charts because they are looking a bit more dangerous now for those equities. And also, have a look at maybe a bit of oil and gold. Plenty to talk about this week. So let's jump to the charts. So just starting off with those 10-year bonds I spoke about last week. I'm just really showing you the short-term charts on this because it is starting to break out. The level I was showing you last week was that 1.8% region. This is a yield on the 10 years. And we did see a spike in yield up to 1.9%. And now rates are falling at the moment, sort of retesting that breakout level. So where bonds go from here will be interesting. Will the buyers step back in and will yields fall again before turning back up? So we could be in for, a bit of a rally in the bonds. That often happens. I always talk about these false breaks that occur, and we could be in for that. But it really feels like there's a bit of a line in the sand now for the market around that 1.9% region in those US 10-year bonds. So we've got a bit of buying in bonds, so the yields are falling. But if you see them turning back up and shooting up through 1.9%, that's when you should be a little concerned that we could see those risk parity funds who are very exposed to stocks and bonds, and they're leveraged up, so they have very big exposure to the bonds. If you see stocks and bonds selling off, they can end up being forced to cut and run, or at least lower their leverage and exposure, because they'll be losing money on both legs and their leverage. So it can hurt very quickly when things go pear-shaped. So just keep an eye on that with those US bonds. And moving on to these equities, I have been showing you how this has been looking. I'll switch over to the S&P 500 on the daily chart just to show you the move that we've had this week. The first thing to point out is that 200-day moving average. This is the COVID crash you can see there, and then the bounce. So prices have been holding above that 200-day moving average in a really amazing steady trend for over a year now. And it's only in the last week that we've seen some selling pressure really pick up and the price going back to test that 200-day moving average. So if the buying pressure could be there, and things could bounce, all well and good if it does turn back up from here. But once you're starting to flirt with that 200-day moving average and things are looking a bit bearish with those bigger players starting to come out and really sell into the market, as we saw on Thursday night's trading, which I was telling you about in the article, where prices rallied over the day and then the sellers came in around midday and pushed the market 3% down, which saw prices breaking below the low of the move from a few months ago, from December. So, it has actually broken down through that level and looking a little bit dangerous as it heads to that 200-day moving average. But I guess the next key level to be watching out for really is that low of the move. And that level coming in around sort of 42.50, let's say, in that S&P futures. So, we could see a bit of volatility in the short term. But look, often things don't go in a straight line. And you'll see the last time we broke through the 200-day moving average, you can see it had a bit of a panic sell and then rallied all the way back above the 200-day moving average, started to look pretty good again. And that's when the music stopped and we went into that COVID crash. So it's not a simple thing around the 200-day moving average, just saying if it's above, it's bullish, and if it's below, it's bearish. That's far too simplistic. But we could expect to see yeah, lots of volatility as prices head through that 200-day moving average. And, there'll be lots of people lined up trying to support it there, not allowing it to go through. And there'll be others getting bearish, thinking it's going to collapse under there. So it's just a point where the market really starts to see increased volatility. And that is what you should expect going forward here. So moving on to our market, to the ASX200. I've been showing you this setup for a while as well, saying that I was a bit concerned about what was going to happen if things did turn down. We've been stuck in a range for 8 months. It's been very difficult trading, hard to make any money. I've been telling you to just, go fishing rather than try to trade this market. It's been a complete nightmare to trade. But that could mean that it's been tracing out a topping formation. And that's what I've been most concerned about. And I'm looking at the old highs I talked about last week, the 07 major high before the crash. And then we've got the high prior to the COVID crash as well. And the way I look at these things is the market attempts to break out above those levels and carry on. People get bullish. The bears capitulate, cover their positions. And, often you can see periods like this, months and months of trading above that level. And then if it can't carry on and that range fails, and all of a sudden it's selling off below those prior highs, that's what I call the false break. And that's when you can see a bit of panic ensue, and you can see a bit of mean reversion in the market where it really sells back off and shakes a lot of people out of their positions. So it sort of feels like we're on the edge of that coming. It can take time to play out, but we have had 8 months of sitting in this range. And as I say, like shaking up that Coke bottle, you keep shaking up that Coke bottle for a long time. All of a sudden you lift the lid off and it's chaos very quickly. So that's what I think we're getting close to, the US market resting near that 200-day moving average, and our market selling off nearly 200 points today and threatening the low of the range of the last 8 months, threatening to create a false break of the major highs from the last 2 decades, really, or decade and a half. It's just a situation where you can see short, sharp, panicked selling for a while. And look, that could set up a fantastic buying opportunity for down the track, no doubt about that. But it's just one of those setups for me where I'm just a little wary. And, I think I've shown you this before. If I'm looking at this trading over the past decade, I do what's called a linear regression, which is basically looking for a line of best fit in the market, looking at the prices as they move. So with this linear regression, I'm looking just at the 2 waves we saw here back in 2008 to 2015, making a calculation off that of, this line of best fit, which is sort of saying what the trend of the market is. So that's like a, really long-term trend that the market's seeing. So when you've got prices, up in the top section, that's a bit of a high risk area where you could be ready to see a sell-off back to the low of the range. And you can see there, that's been good buying, buying it near the bottom of the range. So where we are right now, right at the top of that range of the linear regression of that sort of past decades trend. And if it sells off, you can see, first of all, a mean reversion to that line of best fit. And even it could, jump out the other side. And, down there, down around 6,500 odd, that might be great buying for the next leg up. So basically the market's just, in that very long-term trending up, but it's a period right now where it's a bit overstretched to the upside, and I could just expect it to, have a bit of a sell-off just to scare a few people out of their positions. So hopefully you have been following along and you're feeling prepared for what may be coming down the pike. It's not necessarily time to panic, but it's certainly time not to have too many positions on that you're fully exposed to, and to just tread a little carefully and see how this US market handles that 200-day moving average. So that's it for this week. I'll come back with more next week. Definitely check out what I'm up to below the video. Click on a few links there. Check out my Australian Small-Cap Investigator and the Pivot Trader. and come and join me and have a trade. All right, I'll come back with more next week. Cheers.